that yes, it's good to pursue profit, quite all right. And banks are very good at that. And why do I say that? Because our banks are very good in strategy. And they invest in it anyway. So I don't therefore, have any issue with banks making profits. But then that must be balanced with how we connect what they do with the rest of the economy, especially the real sector. And that is where I think they should pay more attention. Capital is good, yes, they become bigger, and they have more muscle to finance transactions. But then they focus more on where the problems are. And again, ultimately, it's to their benefit. But the more connected they are to economic activities, the more money they make.
How do you think the regulator will be able to handle this in terms of regulatory framework that need to evolve to look at the asset quality of these financial institutions, these behemoths that are emerging, even as they most likely will go, if these predictions come true, to take the lunch from other smaller banks moving forward?
All the analytics that was presented this morning had indicated the way forward. What we will see in the next 10 years in the banking sector, digitalization will separate the whole core activity. But my concern is whether central bank, as we know it of today, is going to be, at speed with what is going on in the market. Because if central bank is not at speed with what is going on in the market, there'll be a lot of distortion. You will see banks declaring, the FUGA banks, they are declaring both interest income and non-interest income. So you cannot really, separate it in terms of regulatory issue. The banking supervisors will come, they will only look at the books of the banks. The whole core, income is also, diluted. It's already in the bigger purse of the bank. So it's going to be a serious problem for regulator. The regulation that will come in this recapitalization or capitalization will be different from what happened in the first capitalization. Because the banks are very smart now, smarter than before. So most of their income, 1 trillion naira profit that they are declaring, is not wholly from banking activities. And how do you dissect that? How do you separate that? So I think central banks should begin to train their staff to be able to be more forward-looking in businesses in the economy. Because we have other financial departments, what they call OPID. Those ones can be engaged or trained to be able to look at the other aspects of holdco, so that the balance sheet of the holdco will be separated from banking, as it were.
It's like we're just revolving around the same the cycle. So you look at before the consolidation, you see that there was like separations. Banks specialized in different aspects, and later on they had the holding structure. Then there was a policy that said that they sold off their subsidiaries.
Yes.
Now they are back to
them
buying back
again.
those subsidiaries.
So we decouple and couple back again.
It's just still like within the same cycle. But I feel what we can see now is that there's better regulations compared to what we had in when banks they were doing a lot through their subsidiaries. And with like what Madam mentioned, that there needs to be understanding of how those subsidiaries, how they would you're able to play by the books. So you're not using those subsidiaries to circumvent regulations. But there's a need for those financial services. You know, we're in the era of technology, which Mr. Shitabe mentioned on AI, it's coming in. When you look at even those that plays, you look at the financial technology companies, when you look at transactions that's being carried out by them, so when you look statistics based on NIPS, say that about 40% of the total NIPS transactions were carried out by the likes of OPay, PalmPay. So there's a need to still see how are they able to penetrate. They are getting the volume. To get a loan from Money Point now is easier than commercial banks. And what they use is technology with open banking. And when you also look at the non-performing loan, because of the technology, they're able to look at the behavioral pattern. These are some of the specializations that the banks will need to come in, because banks may take 4 weeks to disburse on that same particular loan, trying to study your behavior, look at all the C's of credit. But if technology can be improved on and can look at your pattern, spending pattern, look at your credibility, get details about you, and pull that down, give a scoring, and they begin to improve on it. So that is helping them to even go into credit faster than even the commercial bank.
The larger equity bases the bank will have, there will be so much money, ₦500 billion naira, that's a whole lot of money, going by whatever inflation, exchange rate, whatever, no matter how we slice it. So how do we get this huge amount of money, whether it's in tier 1, tier 2, tier 3, but in particular, mostly for the tier 1, to support the growth of the economy post-recapitalization? We're talking about 9 months, whatever, down the line.
The first thing I want us to put to mind is the fact that banks don't lend out of their capital. Capital is a driver of deposits, as you said.
Yes.
But with more capital now in the pocket, it's a motivation to go for deposits, which they will now create risk assets from,
Yeah.
generate income, and do all those things that we understand to be additions to the economy. Now, that given, then the other key issue is that when I was privileged to be the team lead for the credit market team, where we worked on the FSS 2020, and we all came to an understanding that if this economy was going to grow, the aspiration then actually was to grow the economy to $963 billion.
2004.
Almost $1 billion.
Yeah.
Then,
Yeah.
that was the aspiration for year 2020. And we said, if that will happen, then the credit market in Nigeria will be the driver of that. So the question now for us is, with banks having huge capital in the outcome of the ongoing exercise, how will that connect to driving the credit market to support the economy, grow its GDP? A number of gaps we saw there in the credit ecosystem. But interestingly, the current Tinubu administration is addressing that, especially with this new institution, credit guarantee, that was just, leadership appointed into it, okay, and the board. Now, what we saw then were challenges to our credit culture, and then banks also holding back from creating risk assets in some sectors because of risk concentration. So what the credit guarantee institution now will do is to de-risk some activities and therefore enable banks to lend to them. Maybe I will suggest to Proche that in subsequent reports, you probably want to introduce a metric that will help us in this direction, and that is impact. So measure impact. So not in terms of the volume of risk assets or how much income we generate from them, but how many in terms of number. Then also in terms of sectors that are impacted by the credit operations of the banks. If we go that route, we get more value from the capitalization outcome.
In 2024, the total domestic credit to the economy. It was just a bit above 100 trillion from all the banks. In 2024, and even currently 2025, the current MPR is 27.5, with a symmetric corridor at plus 500 and minus 100. If you look at all those sectors that are listed in Crucial's report, there are a number of them that need money to move, to grow. But how many of them can borrow at over 30% and still generate returns that would give them their capital and a little bit interest on what they have done about? So in essence, I'm saying that the central bank also needs to look at that. If we really want the banks to, if we really want to encourage people to borrow and, move the economy forward,